In 1910, a secret meeting between some of the world's most powerful private men took place on the secluded island of Jekyll Island. This is where the idea and the plan to form the Federal Reserve were hatched. This meeting was so secretive that they did not even admit this meeting happened until the 1930s. Now, given the fact that today the Federal Reserve is number one and the most powerful economic decision maker in the world, number two is not a company, number three is not a federal agency either, and number four is not accountable to either shareholders or to voters. It leaves the inner workings of the Federal Reserve shrouded in mystery and suspicion. So, let's get to the bottom of this. First, who really owns the Federal Reserve? The Federal Reserve is the central bank of the United States, but it was not the first central bank in the nation's history. There is a long-standing debate among the founding fathers regarding central banking, with some firmly opposed to it, while others advocated for its establishment. This divide ultimately led to the creation of three central banks throughout U.S. history. One of the most prominent opponents of central banking was Thomas Jefferson. Jefferson was deeply skeptical about the concept, often warning against the dangers it posed. Although a quote often attributed to him states that, "If the American people allow private banks to control the issuance of their currency, first through inflation and then through deflation, the banks and corporations that arise will deprive people of their property, leading to future generations waking up homeless on the land their ancestors conquered." This quote first appeared in the 1830s and is not a direct citation from Jefferson's work. However, its sentiment resonates throughout his writings and speeches. Jefferson famously stated that banking establishments are more dangerous than standing armies. He also argued that the principle of spending money to be paid back by future generations, under the guise of funding, essentially amounts to swindling future citizens on a large scale. The opposition to central banking among Jefferson and other founding fathers stemmed from their experiences with the financial instability of their time. Under the Articles of Confederation, Congress was granted the power to print money, which led to rampant inflation. At one point, the continental currency experienced a monthly inflation rate of 47%. To prevent such mistakes from recurring, the authors of the Constitution, which replaced the Articles of Confederation, limited Congress's monetary powers. They stripped Congress of the authority to print money, granting only the power to coin it. It was, at least in part, due to this historical influence that central banks struggled to take hold in the United States until the establishment of the Federal Reserve in 1913. The creation of the Federal Reserve involved a meeting at Jekyll Island, where participants devised a plan to establish a central bank in the United States. They decided to call it the Federal Reserve, encouraging Americans to believe it was part of the federal government. However, it was not enough to simply use this name. They needed the government's endorsement to grant it legitimacy. This led to the drafting and passage of the Federal Reserve Act, which President Woodrow Wilson signed into law in December 1913. Over the years, the Federal Reserve has evolved, and we know that an organization's origins do not necessarily dictate its current structure. Today we must consider who owns and controls the Federal Reserve, and importantly, who profits from it. The Federal Reserve was created by an act of Congress and can be altered or even dismantled through subsequent congressional action. For instance, in 1977, Congress granted the Federal Reserve a dual mandate. This point is crucial. The Federal Reserve exists because of Congress, and its responsibilities are defined by congressional oversight. However, while Congress has the authority to direct the Federal Reserve's broader objectives, it does not dictate every detail of its operations. Particularly, Congress does not control the Federal Reserve's day-to-day decisions, especially regarding monetary policy. Monetary policy encompasses the actions and guidelines set by the Federal Reserve, including the decisions made by the Federal Open Market Committee, FOMC. There are two main components to understand regarding the Federal Reserve: its balance sheet and interest rates. The Federal Reserve's balance sheet represents the total value of all the assets the Fed has acquired using money it has created. These assets primarily include mortgage-backed securities and U.S. Treasuries. Additionally, the Federal Reserve sets interest rates in an attempt to influence the rates of loans throughout the economy. Since the Federal Reserve controls the dollar and shapes its value through monetary policy, which in turn affects the dollar's status as the global reserve currency, one might expect that those making these decisions would be accountable to voters. However, this is not the case. Monetary policy is determined by the Federal Reserve's Federal Open Market Committee, FOMC, which is composed of 12 members. This includes 7 members from the Board of Governors of the Federal Reserve System, the President of the Federal Reserve Bank of New York, and 4 of the remaining 11 Reserve Bank presidents who rotate annually. The FOMC is responsible for deciding monetary policy for the most powerful currency in existence today. The committee consists of 2 main groups, the Board of Governors and the Reserve Bank presidents. The members of the Board of Governors are appointed by the President of the United States and confirmed by the Senate. Their terms last for 14 years and are staggered to avoid coinciding with U.S. presidential elections, ensuring that no single president can significantly influence the board's composition. As such, the President and Congress are responsible for choosing the Board of Governors, who constitute half of the FOMC and are key to determining monetary policy. What about the other half of that committee? The Reserve Bank presidents. Who are they? The Federal Reserve has 12 regional banks located in Boston, New York, Philadelphia, Cleveland, Richmond, Atlanta, Chicago, St. Louis, Minneapolis, Kansas City, Dallas, and San Francisco. These district banks oversee all the banks in their respective areas. The board of directors for these regional banks is elected by the member commercial banks. So we have the 12 district banks, and the board of directors is chosen by the member banks. But how do these elections happen? Who gets how many votes and who selects the candidates? The 12 regional banks are structured similarly to private banks, which means these district banks hold shares. By law, to operate as a bank in a district, a financial institution must own shares in its Federal Reserve District. However, owning Federal Reserve Bank stock does not provide the same rights and privileges as owning stock in a private company. These shares cannot be traded, sold, or shorted, nor can they be used as collateral for loans. Additionally, they do not confer voting rights in the same way that shares in publicly traded companies do. This raises the question, why do these banks need to own these shares if they lack voting rights and cannot be sold? What purpose do these shares serve for them? First of all, the original funding was used to set up the 12 reserve banks. Each bank has 1 vote, regardless of the number of shares it holds. Some banks own a significant number of shares. According to a Freedom of Information Act request by an institutional investor, the Federal Reserve Bank of New York released information showing that Citibank held 42.8% of the total shares, while Chase held 29%. It's important to note that individuals cannot own shares of these banks. Only other banks can hold shares in the Federal Reserve banks. An interesting aspect of this system is the candidate selection process. Typically, only a single candidate is presented for each director position, which suggests that larger banks with numerous shares in their reserve banks may have significant influence in selecting those candidates behind the scenes. So yes, every bank is required to own shares of its reserve bank, and each bank gets a vote on who becomes the director or president of their reserve bank. However, it raises the question, how much does each bank's vote truly count? In conclusion, understanding the intricacies of the Federal Reserve reveals a complex interplay of history, power, and economic strategy that affects us all. While its origins may raise eyebrows, the institution today plays a crucial role in shaping the financial landscape of our nation and the world. As we unravel these layers of economic governance, it becomes clear that awareness is key to navigating our financial futures. If you like the video, please like and share it with your friends. Thank you for joining me today, and I will see you on the next one.